Hi everyone, it's Zaki Ameer from DDP Property. Coronavirus, Covid-19 and the property market. What does it mean for property in Australia and internationally? Such an interesting time we're living in, but it's not the first time. The world has suffered pandemics like this before. Maybe not in our generation or the previous generation, but definitely in previous generations much older than that. Taking it back to the Spanish flu or even the Black Plague and so on. So we've been through this before and we're far more intelligent, technologically advanced and far more together in the use of how we transmit good information so that the world survives with the least amount of disaster. But let's talk about the property market. Property has always been a resilient asset. It takes nearly 3 months for a property value to be adjusted in comparison to the share market. The share market has just had a free fall over the last few weeks, taking it back to nearly the falls of the 1987 Wall Street crash. And was it predicted? In my opinion, yes. For the last year or so, I've met a number of clients to our financial partners. And many of the clients would say, Zaki, the share market is performing really well. Why should I buy property? That's true. The share market has overperformed, sometimes averaging 10% and in some international markets above 10%. That's excessive growth. Over time, which is usually 10 to 15 years, the share market and the property market in good properties and good shares performs the same, on average the same. What's that? 6 to 8% growth. So when I've had people say my superannuation fund is doing really well, it's invested with one of my fund managers and they're obtaining 10% plus growth. Why should I buy property? That's exactly why you should have bought property. During that time, I've sat with many clients and I said, this gap cannot continue. The spread is too wide. The share market performing above 10% and the property market averaging 6 to 8%. Let's look at property over the last 5 to 7 years in Australia. We had good growth between 2014 to 2017 and an adjustment was well required. The Australian government stopped Chinese investors buying in, they put in stamp duty restrictions, foreign investment buy restrictions, they made investment lending far more harder to be able to obtain a loan. A number of our clients suffered through that, not being able to get finance, and it was an adjustment that was needed. And since then in 2019, in the last quarter, because interest rates have continued to go down, and banks need to lend money and such APRA removed the pressure to make bank lending easier, the property market started to move up in the last quarter of 2019. Because of investors like yourself or first home buyers in which the government were guaranteeing deposits were getting into the market and such, we started seeing the property market move upwards. But why were interest rates so low? Simply put, and I don't want to overcomplicate this, it's because people aren't spending money. Consumer confidence is low and people need to spend money and borrow money to keep the economy going. And such, the interest rates continue to fall down. So it's no surprise that there was a recent pandemic coronavirus interest rate cut to 0.25. It was predicted anyway that interest rates were going to go low regardless of the virus or not, because it was on its way low anyway historically. And such, property becomes such a desirable asset because you're paying 0.25 plus the bank's margin to get a loan. You look at the share market, it's been in free fall. I've had many clients ringing me now who didn't get into the property market saying, Zaki, my superannuation balance has gone down 10, 20, 30% depending on the aggressive strategies they were in. And these were the clients that said, hey, if you don't want to buy property, at least keep it in cash. But you can't just keep it in cash because the only way to create money is to invest. And it is about taking risks, but it's all about calculated minimizing risk strategies, not unnecessary risks which when I hear someone say, or many people say, wow, I'm making so much money here in the share market and so on, that's the time to be getting out. So what about the property market for the next 6 months and so on? Well, let me repeat, the share market was due for a correction and it takes at least 3 months for property values to adjust. Why is that? Let's say you wanted to sell your property. You call your lawyer or conveyancer, they take 4 weeks to prepare a contract. You call your local real estate agent, they'll take 4 weeks to prepare an agency open house campaign. And such, we've got to have to deal with open homes or virtual open homes since the Prime Minister's made a restriction on that recently in the last 24 hours. And it'll take at least 3 months by the time a buyer and seller come to an agreement on price. 3 months for property values to adjust where the share price is on a free fall. What could happen in 3 months? Well, let's look at Wuhan, China. January when they went public about the coronavirus, and already by March they're reopening their factories and the lockdown laws are getting lower. That means that was a 3-month resolution in this coronavirus pandemic. With strong leadership in Australia, we hope that in 3 months we're out of this. But what does that mean for property? Well, it means not much happened in values. But what about the interest rates? Interest rates are lower anyway, regardless of the pandemic. But what happens if interest rates continue to fall because consumer confidence and people aren't spending money and banks need to lend money in order to keep the economy going? We may fall into negative interest rates. It's a term not many have heard of because we've never in Australia had negative interest rates. So what's a negative interest rate? It's basically if you kept money in your bank account, 10,000, 50,000, 100,000, so on, you will get charged money, fees by the bank or interest for keeping that money with them because they want you to spend it. Imagine that. Keeping money in your savings account, you will get charged an interest for keeping it because they want you to spend it. And what does that mean for people that are borrowing money from the banks for a home loan, for example? The banks will end up paying you an interest for taking a home loan. Using DDP's strategy anyway, most of our properties are neutral into positive cash flow that puts money into your pocket, part of our strategy on a well-balanced portfolio. But imagine on top of that, the banks are paying you an interest for taking a home loan. Your properties are going to be even more positive. And the banks want to lend you money because the economy needs to be stimulated. What a great time to be getting into the property asset market. Never better. Share market's crashed, people have lost money in the share market, and property has always been a safe haven. What's the basic rule of that? Is because everybody needs a home. Let's look at the campaign right now that's running. Stay at home. Globally, everyone is saying stay at home. The hashtag stay home, stay at home. What's the common word? Home. Everybody needs a home. And for my viewers like yourself, when you make that decision to buy a property with historically low interest rates, maybe negative interest rates, that may happen. And if it does, well, that's good. You'll earn more. But imagine you get in the property market today with nearly 2.5% interest rates with some of the major banks, could be possibly lower. Banks' ease of lending to you. You buying a property, you're promoting and giving jobs to the real estate industry. You're giving workers in the construction industry because most of our properties, we like to advocate are brand new properties that give you a $25,000, $30,000 cash back of equity guaranteed. So you're promoting the construction industry, the construction workers have a job and so on. But at the end of it all is you're giving someone a home to live in. That's what you're doing, and that's why it's called a tax deduction, because you're giving somebody a home. You compare this to the share market right now. I've got many friends who invest in the share market considerably, and they've taken marginal loans. And just like the 2007 crash, the banks on them or the lenders are saying, hey, that your shares have dropped in value, you better top up or we're going to have to sell the shares for a loss and then you owe us the funds. You don't see this happening in the property market. So which is it, shares or property? In the long term, good property and good shares perform well. It's about what you buy when. And in the last year, I've advocated to stay away from the share market because it's performing above 10% and a correction is needed. Now that correction has happened, or it's continued to happen, I think it's going to the share market is going to drop a bit more. It's no better time to get into the property market with such low interest rates. And many might ask, well, Zaki, I need a job to get into the property market. Well, as you can see, the Liberal government and Scott Morrison are doing their best to keep the jobs going, to keep the jobs safe. That if you've lost a job in one industry, you may be working in a different industry that needs jobs. So that's your decision to keep this country going, to keep yourself employed. Okay, we have a great opportunity in Australia that we all stick together and we find ways to help each other. But in the end of it all, everybody needs a home, and there's no such better time to get into the property market than now in 2020.